Hello and welcome to Portfolio Matters. Now, last year we did a very popular video in which Stuart Owen updated us on how his VCT and EIS portfolio had done. The problem with EIS and VCTs is that companies don't report their losers. So they're very keen on telling you about the ones that have done well, but they don't tell you about the ones that have done badly. And I know from personal experience, I've had some really terrible VCTs which have returned zero. So it's great to have Stuart give us his experience from all his VCT and EIS investments. And now he will provide an update. But before we get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities that we own or have financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Take it away, Stuart.
Thanks very much, Keith. So as you mentioned, this is an update on the initial presentation that I did covering EIS and VCT. So I'll just provide a very brief summary of what EIS and VCTs are about, and then get into the meat of how performance has been. So at the heart of both EIS and VCTs, it's really all about providing venture capital to UK investors and cushioning the risks via some tax kickers. So the rules around which companies are eligible to receive EIS or VCT money are reasonably complicated, but the point is that they're about small, innovative, risky companies which must be conducting certain trades, and those trades exclude areas where it's possible to sort of engineer a financial return. So things like property or hotels or farming or energy generation. Some of those had been permitted for a while, but that got closed down. In fact, more generally, the rules were tightened in 2015 to make venture capital investing genuinely about venturing your capital and not about prepackaged financial products. The companies that one invests in are very small. Typically, they're unquoted, or they're at the small end of the AIM stock market, with gross assets of less than 15 million and less than 250 employees, and quite recently formed companies, so usually less than 7 years old. There is more detail, but that's the overview. So investing in such areas is, of course, risky. So the government has provided various tax advantages to encourage investors into these areas. Enterprise investment schemes have more of the tax advantages, which generally reflects the higher risk. And those tax advantages are headlined with 30% income tax relief. So you put £1,000 into an enterprise investment scheme, you get 300 quid off your income tax bill. But you can also defer any capital gains that you own by investing those gains into an enterprise investment scheme. Any growth in the EIS company is tax-free. And if you make a loss on the investment, that loss can be offset against income or capital gains. And as Keith alluded to, this loss relief turns out to be pretty important because there are quite a few losers out there. Also, after you've held an EIS investment for a couple of years, it becomes eligible for inheritance tax relief. Now, what all those tax advantages mean are that if you invest in an EIS company, your maximum loss is 38.5% if you're a 45% taxpayer, i.e. all the upfront income tax relief and loss relief cushions your loss. So it's not a complete wipeout, even if it is a complete wipeout, if you see what I mean. EIS companies, you have to hold them for at least 3 years. We'll get onto it, but in practice, it's never 3 years. It's always much longer. Turning to venture capital trusts, the tax advantages are less. You get the 30% income tax relief, and any dividends are tax-free, and the growth is tax-free, if there is any growth. but there's no capital gains deferral, no inheritance tax relief, and no loss relief. Also, venture capital trusts, you must hold them for a minimum of 5 years. So that's the main tax advantages. Please see the earlier presentation for more detail, but that's the big picture. So updating what my EIS experience has been so far, well, I've had 85 realizations so far. Now that may sound like a lot, but typically I've invested with managers who have spread, say, a 25 grand investment across 10 companies. So there are quite a few small investments in practice. Alongside that, I have tried to pick a few individual stock winners and have got some larger exposures to individual companies. But yeah, 85 realizations so far. That covers some green energy companies which were initially permitted under the EIS rules, but no longer. It also covers film companies, nurseries, some AIM stocks, some computer game stocks. And as I mentioned, a lot of these were sourced by managers, including Ingenious, Oxford Capital Management, Foresight, Rockpool, and Octopus. So turning your attention to the little histogram on this slide, you can see the distribution of returns that I've achieved. Now, the largest bar are returns between 0 and 20%. And that's I had about 27 companies return, basically the money that I put in. But then have a look at the distribution. It's very far from a normal distribution. There is quite a bunch of losers. 16 companies where there was a complete wipeout, lost everything. But there were 4 where I made over 250%. And I've had to truncate the x-axis here. I mean, some of these were actually 10 baggers, the only ever 10 bagger I've ever had in my investment career. So it's nothing like a normal distribution. It's very, very lopsided. So averaging that all out, what have I made? Well, for every pound put in, I think I've made about £1.49 of value. So that's broken up into a 12% average investment gain, the 30% income tax relief, and the 7%, another 7% from the loss relief on those losers on the left-hand side of the histogram there. Also, I got some benefits from CGT deferral, but I haven't really quantified them. Now, that is likely to be a somewhat biased, upwardly biased estimate, because this is the realized exits only. So for any company that is still limping along, that isn't in the chart because there's still some hope value that that some of them may come good. But the thing I really want to emphasize is just how wildly lopsided this is. I've made, I think, on average, a 12% investment gain, but it really is bailed out by the few big winners. And I'm definitely reminded of an aphorism that was told to me at the beginning of my sort of venture capital career, which said that investment in these areas was for friends, family, and fools, and that you should think that for every 10 investments, you might get 1 real star, 2 break even, and 8 complete losers. Now, it's not exactly those stats, but it is that sort of an outcome where you're relying on a few mega winners to bail out the much larger number of losers.
Thanks, Duke. Really interesting statistics. I'm amazed you've had 85 realizations. So this becomes kind of statistically significant. So can you just talk us through the big winners and big losers? Are there any commonalities, do you think, between them?
Oh, well, although there's 85, it's difficult to really pick big themes. Amongst the winners, there was a computer game company that you and I know well.
Yep.
There was also a biotech company. So I mean that in a sense is a lottery stock, isn't it? Whether they work or not. Another was a company called Pasta Evangelists, which I invested in, and which was taken over very quickly, in a sense, during the Uber and techie sort of boom over the past couple of years, people hoovering up anything. So it's difficult to see commonality in the winners. In the losers, there was a fraud, there was some change in regulations, there was some incompetence, but perhaps we should also just accept that most new companies fail, and you do need the occasional winner to bail it out. But I can't really identify any common theme. So adding a bit more colour to the EIS experience, we covered this before, but just to reiterate, there really are very high fees here. Initially, it was difficult not to be sort of enthusiastic about all the tax allowances, but getting 30% off your tax bill sounds nice, but you have got to realise that the fees are going to be eating up about 15% over the life of the investment. It's 4 or 5% to go in, 2 or 3% a year, management fees, about possibly 5% coming out. There's a pretty heavy tide working against you. It's also very clear that you've got no control with these things. You're completely a passive participant. Obviously, you don't really have any control over Vodafone if you invest in Vodafone, but you do have information, you do have liquidity. And with these companies, you put your money in, you sit back, and you've got no control. And the degree of information you're given varies wildly by different managers. Managers such as Rockpool did actually provide occasional P&L and balance sheet information. Other managers, you'll get 3 or 4 lines, and in some cases, you just get nothing. Another thing I'd really highlight as a warning to people is that there really is this limping on risk. Given that any loss on an investment is tax allowable, from the investor's point of view, if it's not working, you'd rather it was killed and you've got at least the loss relief on the bad investment. But for the manager and for the operators of the business, there's possibly an incentive to keep limping on. They want it to work, maybe there's a chance. And you've got very little leverage to wind it up and at least crystallize the loss. I'd also stress that if anything can go wrong, it will. I've been flabbergasted with some of the sort of operational screw-ups. I invested in one EIS where the pitch was, here we are, we're some people who have done maintenance on offshore wind farms. We know the industry. We believe there's a niche for a particular type of vessel that will go out and service these wind farms. But the boats they built, they didn't have the right waterproofing on them. And the boats leaked. There was a big legal case, insurance costs, etc. So it's just phenomenal what can go wrong. I invested in some nurseries, and there was a big fraud there. That's actually something which I covered on a previous Portfolio Matters experience. I invested in some EISs connected with the film industry. That always seems to be a recipe for disaster. And I invested in some companies which were building little peaking energy plants. And the idea was you would scalp high electricity prices, but then there was changes in the regulatory structure, and those became worthless. The final thing I'd stress about the EISs is that the paperwork. It became a real headache keeping track of everything. As you can imagine, I've had 85 realizations, and there's still quite a few more hanging on there. In particular, if a manager sells a company under EIS and it does it within those 5 years, you have to write to HMRC and say, aha, it didn't last 5 years. I claimed a tax allowance that is no longer applicable. Please bill me for the tax which I previously saved. And this becomes a real pain when there are partial sales. So I was invested in one EIS, which itself invested in about 15 AIM stocks. Now, the manager saw that some of those AIM stocks had sort of gone up 4 or 5 times. And so it sold some of the position. You're making a nice profit, you shouldn't be complaining. But they only sold, of course, part of the holding. So then you've got to redo all the paperwork and write to HMRC telling them that you've partially sold some of this. You need to partially repay the tax. You need to partially pay the capital gains tax, which you had previously deferred. So it becomes a bit of a spaghetti of maintaining and logging everything. I mean, it's not fundamentally that difficult, but it becomes a bit of a pain, in particular if you're doing your own tax return and finding the right boxes to enter all this data, particularly when you're doing something from a tax filing from a couple of years ago, for instance.
So before you move on, Stuart, you're talking earlier about how you thought 149p, so you've made a 49% return on average. What time period what is the average time period before you get the money back, would you say?
I would say 5 to 6 years. So it's nothing like the 3-year minimum holding period.
Right. And does that include both EIS and VCTs? Or
VCTs, it is to some extent up to you, because after you've held them for 5 years, they are quoted stocks. So it's up to you when you realize them. Right. So that's much more under your control. The EIS, it's up under the manager's control, or if you've invested directly in a company, it's about the managers of that company finding an exit.
Pause a sec, because I want to work out what the compounder of
it's a pain in the ass, because you've got to compare it to the situation if you had paid tax.
Yeah, no, that is true, actually.
That's the problem.
Yeah, okay, well, I won't bother then.
Yeah. In fact, I never have it totally clear in my mind whether it's been worth it, because you've got to invest, say, 100 to save your 30. So the 70 that you would otherwise have had after tax has then got to grow to the 149. So you've got to more than double your money in 5 or 6 years. So that is, in terms of the compounding there, I mean, that's going to be what, about 15% a year of return.
Okay. So for you, it's worked, basically.
It has, but it needed those few big winners to bail out the many losers.
And I should add at this point, I haven't done the maths in the way that Stuart has. I've only done, I think, 5. And we've just had, Stuart and I, a big loser, which is going to return 0, and that was a film EIS. But both Stuart and I have had a big winner in the form of a video games EIS investment, which returned 17-fold. And so if you looked at my portfolio, I'd probably have had an incredibly good return, actually, in some, but that's all because I've had one winner. And frankly, all the VCTs that I've invested have been very disappointing. So I invested in 3. 2 of those are going to return less than 50% of what I put in. 1 is going to return a little bit more. So you're right. My distribution is very skewed like yours, but it's going to look very good because I had this one great winner.
Yeah. You've got to go in, actually. You've got to believe and really understand that those are the risks. You're not going to be able to pick the winners in the way that you think you are, because there's an awfully big risk out there of these things going pop.
Yeah. Okay,
so turning to venture capital trusts and my experience with those, well, the big thing is the paperwork is so much easier. It's a joy to deal with. There are fewer tax advantages, so there's no CGT deferral and there's no loss relief. It's also easier in the sense that there's a very small unit size. You can typically invest in a VCT for about $5,000, whereas some of the EISs require much larger minimums. The other aspect of VCTs is you're getting professional stock selection, or at least you're getting stock selection by people who are paid to pick stocks for you. Whether that actually means there's very high quality in the stock selection is, in a sense, open to debate, because of the rule changes in 2015 do sort of mean that we've only had 6-7 years of real experience of what these managers are actually like in terms of picking true venture opportunities, because you could argue that prior to that, they were good at structuring investments to achieve guaranteed minimum returns. But anyhow, if you do invest in a venture capital trust, you do get instant diversification. They might own 20, 50 stocks, and the instant you buy some shares in that venture capital trust, you've got a diversified exposure to all of those opportunities. You also get regular reporting, sometimes quarterly, but at least half yearly. You get NAV estimates and dividends. On the other hand, the venture capital trusts are arguably asset gathering companies. They get paid a percentage of assets under management. So they could just be taking in more cash so they can get higher fees. And quite often you look at the portfolios and you might see that they might have 25% in cash, but they're still doing another fundraising. So you've got to be a bit conscious that they have their own business incentives. Another aspect of VCTs is very, very often you're getting dividends as you go. So you've got the 30% upfront income tax relief, and it's perfectly reasonable to expect something like 5% per year tax-free dividend yield. Now, venture capital trusts are different from most companies in that they can pay dividends from realized capital gains and not from income. When you look at their revenue, the revenue line of their accounts, they're often making a loss, but they're still paying dividends because it's from the capital gains. And you can sometimes get very, very lumpy, big dividend payments when they've had a good exit. So some of the ones I've had have paid out dividends equivalent to about 15% of the asset value. So you are being paid to wait during the minimum 5-year holding period. As we discussed a moment ago, you can time your exit. You must hold it for a minimum of 5 years. But if, for instance, now you thought, oh, hold on, venture capital is very much out of favor, AIM stocks have done very badly, now's not a good time to be realizing my investment, well, there's no problem with that. You can just keep holding and wait for when you think is a reasonable time to get out. Another thing to warn people about is, again, this issue of high fees. Again, roughly, I'm guessing about 15% over a 5-year investment. You pay some fee on the way in to the manager or the broker, 2 or 3% a year management charge, and quite likely you'll be selling at a bit of a discount to the NAV at the end of the investment.
So, Stuart, before you move on, when you talk about selling VCTs in the market once they're past their 5-year holding period, what's the liquidity like? I mean, what's the bid-offer spread like? Have you done this?
Yes, if you wait for a slide or two, Keith.
Okay.
I've got a painful example for you.
Right.
In fact, a VCT which I know is dear to your heart. Right. Shall we press on?
Yep.
Okay. So now I haven't done the same histogram of my performance on VCTs as I did for EISs, because I've only had 3 realizations so far, because I began switching from EISs to VCTs about 5 years ago. So they're beginning to sort of come up for sale opportunity at the moment. So I'll run through the 3 which I have sold, and I can certainly talk about some of the other ones. But in general, the performance is okay. So I've had 3 realizations so far, no overall losses. I'd stress again that the income is a vital component of the total return calculation. And I'd also point out that some of the AIM-focused VCTs have been a real roller coaster. So I show here the Hargreave Hale Venture Capital Trust, which you can see had a massive boom from 2020 into 2021 before coming off quite a lot this year, which is very much a sort of dilute reflection or repeat of the NASDAQ experience. But even so, over 5 years, I made a reasonable return just from the investment perspective. And then, of course, I could add the 30% income tax relief.
Actually, Stuart, so AIM VCTs, can you just describe exactly what they do?
So it's a venture capital trust which invests in some of the smaller areas of companies that meet the legal requirements, but which are on AIM. So it might well be, it could possibly be even an EIS-backed company, which is then deciding to float and to raise a bit of money, and the venture capital trusts are able to buy it. So it does depend on the rules. They can't buy just any AIM-listed company. It's definitely the smaller end of the AIM world.
Interesting. Very pro-cyclical.
Yes, and I would argue that that the AIM-focused VCTs are possibly where to focus at the moment, because there is a price quote, and therefore the VCT, their NAV estimate has to use that price quote, and they've not been able to sort of hide the recent fall in small company and tech company share prices. Whereas some of the other venture capital trusts, I think, have got what should we call it, a lagging valuation mindset. So
Yes.
if you want to be contrary, I think the AIM focused VCTs are interesting because they haven't been able to avoid the markdowns. Right, I keep banging on about the dividends, and here's an example. This is Northern Venture Capital Trust, one of the, in a sense, granddaddies of the VCT world. And it's two charts showing the performance of the same venture capital trust, Northern Venture Capital Trust, but one on the left from the London Stock Exchange is just looking at the share price over the past 5 years. And the one on the right is a total return calculation by Morningstar, including the dividends. So it's a very different visual picture of where the total returns are coming. I'd suggest that the picture bottom right from Morningstar, Northern Venture Capital Trust has done me pretty well.
Yeah. Those are different time periods, though, I see.
The one on the left is, just the past 5 years. The one on the right is about the past 10 or 11 years. Yes, you're right. I should have got a better, clearer scale on that. So, as I mentioned before, I think it's quite reasonable to hope for 5% a year in dividends. Plus, you get the immediate upfront tax kicker. So, after 5 years, it's pretty reasonable to have hoped that you've got 55% of value in your hand, and then it's up to you whether you sell the VCT or not. They are venture capital trusts. They are quoted on the stock market. And like many investment companies, there's a risk of only being able to trade at the discounted share price rather than at the net asset value. So I show here the example of Mobius VCT, where you can see the performance in the blue line is the price return, and in the dark blue line is the total return. So both have been pretty good. There's been a good investment, but you don't necessarily sell at the NAV, you sell at the share price. Having said that, there is quite often an opportunity to sell back to the company. Quite often, the venture capital trusts have a policy where they will buy back at a 5% discount to NAV. Now, this is your main chance to get liquidity. And we were speaking about this just before. And if you look at the little picture on this slide, you can see the Foresight Solar Venture Capital Trust. And you can see the bid offer is incredibly painful, £1 to £1.15p. And I've tried, and it's very difficult to get even a few grand's worth of liquidity. So your main opportunity for liquidity is often the share buyback that most but not all VCTs offer. So your liquidity is nothing like as good as obviously a regular ETF or a FTSE 100 company. You might well be waiting 1 to 2 months after you put your desired sale into a list awaiting the company's share buyback. So that's what I often do. I hold my VCTs in a broking account, and they maintain a list of people who are interested to sell when that VCT does a share buyback. And having had my experiences, you might wait, as I say, 1 to 2 months before the regular share buyback by that company comes back around. Other general observations, I found a website called Wealth Club to be a really useful portal for information on venture capital trusts. They maintain some decent performance statistics. They have some summary information about each VCT. Now they get paid for if you buy a VCT via them, so there tends to be a bias towards the optimistic, but it is a central portal where you can have a look at quite a few VCTs pretty quickly. Also, Wealth Club is one route to some cost mitigation. If you apply for these VCTs directly, you often pay a 4 or 5% hit up front, and that can often be mitigated, perhaps as much as half of that if you go via one of these aggregating services like Wealth Club. There are others out there, that's just the one that I found to be most helpful. Also, I found that they're actually pretty good customer service, pretty responsive. Another thing to highlight is do be careful of the tax rules. You've got to hold these things, as we keep saying, for 5 years, but you can't sell after 5 years and a day and then buy back a month later. And quite often the companies are in continual fundraising mode. So you must leave at least a 6-month gap between a sale and repurchase of a VCT. So my strategy now, well, to do the prudent thing, do your SIP, do your ISA first, then you can invest in normal, regular things with tremendous liquidity and visibility. Avoid the need for EISs and VCTs in the first place. But if you've done what you can with SIPs and ISAs, then yes, have a look at this area. Go in with your eyes open about risks and about fees. With EIS, I would avoid anything which looks like it's a manufactured product looking to limit the risk. You've just got to accept that if you're investing in these things, they are genuinely very high risk. You might get lucky, probably you won't, but the tax allowances mean that you're cushioned even if it goes horribly wrong. But do expect a long holding period and very little information. I've been doing venture capital trusts much more than EIS over the past few years. I'm skeptical of knowing which manager is very good at picking these companies, because the rules, as I said, did change in 2015. So I wasn't sure which managers were genuinely good at picking small growing companies. So I've tended to have a bit of a sort of rolling splattergun program of buying small positions in quite a few of these. For the moment, I would tilt towards the AIM-focused VCTs for the reasons we spoke about before, i.e. those AIM-focused VCTs haven't been able to avoid the markdowns that possibly the generous VCTs have been able to do. So that's been my experience. It's been a roller coaster. I think it's been profitable, and it's certainly been educative.
Thank you very much, Stuart. That's really interesting. I mean, the key takeaway that I take is that if you're going to be investing in EIS and VCTs, you really need to diversify, because actually you're probably going to get quite a lot of losers. So you want to have just those few winners. And if you have a small subset, then your chance of you getting a small one of those winners is quite low. The other thing is I'm quite attracted to these AIM VCTs, because if you were to buy them at, let's say, the bottom of a bear market, then you get exposure to equities plus the tax kicker. And so I think buying those, you need to be quite aware of the equity cycle, because you're going to be holding them for a minimum of 5 years. So you don't want to be buying them at the top of the market and then potentially selling them at the bottom.
Well, it's an interesting time now then, isn't it? It might feel slightly early to you, but certainly the overall AIM market has performed pretty poorly. As we could see in that first chart, the Hargreave Hale AIM VCT has come off quite a bit. But I think it's a good counter-cyclical strategy, and you get the tax cushioning as well. Other AIM-focused VCTs that I've looked at include Amati AIM VCT and Octopus AIM VCT. So you could quite easily put together a little portfolio of 3 or 4 of those things,
Yeah.
and the minimum investment is often quite low.
Okay, well, thank you very much, Stuart. And I look forward to regular updates as you get more exits. 85 is quite impressive already.
Yeah, I will do that. Okie doke.
Great. Well, thank you very much to Stuart Owen. Thank you to all of you for watching through to the end. Please, can you press like and subscribe to the channel? And in the meantime, it's goodbye from Stuart Owen.
And goodbye from Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.